Hello, everyone. Thank you for joining us today. As you're coming in the webinar room, we want to thank you for taking time out today to join this educational event. My name is Marcia Butler. I'm the webinar director at Advice Chaser. Before we introduce our guests and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and could not be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions and make comments using the chat box. We have a big crowd here today, so let me make sure that is turned on for you. Very good. The presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our guests today. We have the team from Sidoxia here. So our moderator today will be Kevin D. Weaver, CFP. Kevin, if you can go ahead and say hello. Kevin's going to be answering, monitoring the chat, right? And making sure that those questions get addressed.
Thank you for having me.
Great. And our presenter today is Wade Sloan. He's the president and founder of Sidoxia Capital Management, LLC, which he founded in Newport Beach, California during 2007. Wade has worked in the investment industry since 1993 and has been a media go-to resource as seen on CNBC and ABC News. He's also been quoted in the Wall Street Journal, USA Today, New York Times, Dow Jones, Investor Business Daily, Bloomberg, Smart Money, and other media publications. And Wade, I'm excited for this webinar today, and I know we have a big crowd, so I'm going to go ahead and let you get to it.
Great. Well, thank you, Marcia. And as you all know, today's topic is dividend investing, the gift that keeps on giving. With that out of the way, thanks for the introduction, Marcia. But for those of you who do not know me, I will tell you a little bit more about my background. I started my investment and financial planning firm, Sidoxia, 15 years ago in Newport Beach. And for those of you wondering, where my company name Sidoxia comes from, it's derived from the Greek word for optimism. It's hard to believe for me, but I've been in the investment industry for over 30 years now. And before I started Sidoxia, I worked in Kansas City for about a decade at a company called American Century Investments, where I managed $20 billion. In addition to all my industry experience, I have some fancy educational letters behind my name. I earned my MBA from Cornell University, an undergraduate degree at UCLA in economics. I also hold what's called a CFA, Chartered Financial Analyst designation, which is a credential held by less than 2% of advisors. I also carry the CFP certification, Certified Financial Planner. So at Sidoxia, we're well equipped to handle the financial planning needs of our clients. At Sidoxia, what we primarily do is manage money for individuals and do financial planning. I also manage a hedge fund, and we provide retirement plans, for example, 401k accounts and pension funds. I also taught numerous investment courses at UC Irvine, in addition to various workshops. And last but not least, I'm a published author of several books, and I'm a blog editor for Investing Caffeine at investingcaffeine.com. All right, that's pretty extensive overview of my background, but if you want to learn more, you can simply Google my name, Wade Sloan, or if you want to check out my books, you can head over to Amazon and type in my name as well. All right, with that introduction out of the way, let's go ahead and dive into today's presentation on dividend investing. Let's start off and talk about the differences between a stock and a bond. Before we get into the definitions of a stock and bond, what you're looking at now on your screen is a Coca-Cola stock certificate from 1956 on the left, and a more recent Philip Petroleum's bond certificate that matured in 2001. Okay, the main distinguishing factor of a stock is that it's a type of investment that gives you an ownership interest in a company. A bond provides no ownership, but it's a loan or investment to a company. And as part of that loan, the company agrees to pay you back your original investment, which they call principal, plus interest payments until the bond matures at a specific date in the future. One of the other main differences between a stock and a bond is that stocks have theoretically unlimited profit potential. So I'll ask the rhetorical question, if that's the case, why wouldn't you just always own stocks over bonds? While it's true that stocks theoretically have unlimited profit potential, all else equal, stocks also are generally a lot riskier than bonds. So, for example, so that's not the case for the bond. You get the principal and coupon. But for example, if a company goes bankrupt, bondholders get paid back first with any assets remaining at the bankrupt company. But in many cases of bankruptcy, after the bondholders are paid, there are no assets left over to pay stockholders. So stock owners in many bankruptcy cases lose 100% of their investments. So in other words, in the event of a bankruptcy, you can think of bondholders as being at the top of the totem pole and stockholders at the bottom. Another point I'd like to make about the differences between stocks and bonds is, yes, although stocks theoretically have unlimited profit potential, bondholders are limited to the coupon payments and the principal, which I've said already. And it's also worth noting that a large portion of stocks don't even pay a dividend. There can be several reasons for that. The company may not have the profits, cash flow, or balance sheet to support a dividend. Companies may choose, number two, to reinvest those profits into the business for certain growth opportunities. So instead of returning the profits to the stockholders in the form of the dividend. And that's exactly what we do. When we analyze a company, when we conduct our due diligence, we dig a lot deeper to see a company's ability to reinvest and pay dividends. That's something that we look at very closely. The other point, the next point I like to make is that dividends aren't permanent. They are variable and discretionary. So as I mentioned earlier, companies, they don't have to pay a dividend, and a vast majority of companies don't pay a dividend. In the case of a bond, it's that fixed coupon payment. And also the repayment of the principal, or what's called par, which is paid at maturity, at the maturity date. All right, so that's kind of an overview of the difference between a stock and a bond. And the way that I like to think about dividend paying stocks is like a tree or sapling. with a lot of growth potential. So that's the goal. So all else equal, we prefer companies with a large growth potential because we want that tree to produce a lot of fruit over its life. We generally do not want to invest in mature or decaying companies with decline profitability. That leaves a lot less for the company to distribute as dividends to their stockholders. In general, we also prefer identifying companies providing a higher yield versus a lower yield, and we do not want to overpay with a price that is too high. There are instances, however, when it's still beneficial and a good idea to buy a low yielding stock. One example of this principle would be growth stocks, which generally do not pay a dividend because, as I mentioned earlier, some companies choose to reinvest those profits into their business to help fund new growth opportunities rather than pay out profits as dividends to shareholders. So when I talk about things like growth stocks, you can think of companies like Amazon or Google, Alphabet, which have been tremendous investments over the long run, but those particular companies, they've never paid a dividend. So again, dividends are not the end all be all of everything, but as we'll discuss further, there are a lot of advantages to dividend investing. So this just kind of reiterates the point. Since we're talking about dividends and trees, you can think of dividends as growing fruit on a tree. And we want to avoid purchasing the so-called dying trees or value traps. A value trap is something that appears to be cheap, but it's cheap for a reason. In many instances, they are cheap because they are low quality. These value traps may in fact be paying a dividend, but because of deteriorating fundamentals, therefore the companies have to reduce their dividends or perhaps completely halt or stop their dividends altogether. So what I want to do is give an example, kind of a real life timely example. And here I'm going to talk about Intel Corporation. For those of you that don't follow this particular company, it's a semiconductor. They make chips that go into computers and cars and everything else you can think of. So in this example, on February 21st of this year, Intel was yielding roughly 5.6%. And I show the arrow to indicate the date, and you can see the stock was underperforming, but a dividend over 5% for many value investors is considered attractive. So the point I want to make here, and as I made earlier, is that dividends aren't permanent, they're variable and they can change. So a day later, the dividend got slashed by 2/3. And today, based on the stock price, the dividend yield has gone from roughly 5.6% down to 1.5%. So effectively, their dividend evaporated over a 24-hour period. So the question then becomes, why did Intel cut its dividend? So what you'll see is that the profit expectations for Intel are expected to decline by 74% based on Wall Street analyst estimates this year. And they essentially didn't have the money and resources to pay the dividend. And without getting into all the nitty-gritty details, a lot of competitive forces were at play here. AMD is a large competitor who's been basically eating Intel's lunch. And there's been a lot of execution mishaps in the various new technologies and the chips that Intel has been coming out with. So we'll stay tuned and see if Intel can return to better profitability, and perhaps they will increase their dividend in the future. All right, this chart shows the upward trajectory of dividends for the S&P 500 for approximately the last 25 years. So it's a thing that not a lot of people pay attention to, but it's a powerful chart. And what this demonstrates also is you don't have to buy individual stocks to benefit from dividend growth. You can buy a basket of stocks like the S&P 500 mutual fund, exchange traded fund, or index fund, and you can still participate in receiving these rising dividends. And so, you know, over time, the historical trend line for dividend growth has been about 6 or 7%. And basically what that tells you is every quarter throughout the year, dividend stockholders receive a check for dividends, or it gets deposited into their brokerage account. And on average, over every 10 years, those checks double in value. And so the longer that you hold those dividends, the more you're going to benefit from that compounding growth, which I'll talk about more in a bit. You can think of the S&P 500 as a basket of the largest 500 American companies. And what this chart shows you is that approximately 80% of the S&P 500 companies pay a dividend. And, you know, going back to the early 1980s, that was that percentage was even greater, you know, closer to, you know, over 90%. The S&P today is paying roughly a 1.6% dividend yield if you purchased new shares today. But as I mentioned, that level of dividends should increase over time. So I alluded to this a little bit earlier. Because dividends generally grow at about 6% or 7% annually, if you properly select securities, the longer you own dividend-paying stocks, the higher your yield will be over time. So in this chart, what this shows you is that if you bought a basket of S&P 500 stocks in 2000 or 2010, that's the yellow and green lines at the bottom of the chart. Your yield that you'd be earning today would have increased to a little more than 5%. So more than triple the yield today by holding that basket of stocks for 10 or 20 years. At the opposite end of the historical spectrum, if you had purchased the S&P 500 in 1970, that's that red line, you would be earning a whopping 79% yield today, and you'd be earning that annually. So again, this points out that power of compounding and of dividends. And to put that into better perspective of how important dividends are, over the last century or so, dividends have accounted for roughly 40% of the total return of the stock market. So when we talk about total return, that is price appreciation plus dividends. And so again, the power of dividends and dividend growth is a very powerful concept of compounding. And it is even more impressive when those dividends are reinvested. All right, moving on, I want to give an example again of this concept of compounding yield. And this can be illustrated through the stock of Apple. So Apple today pays a paltry 0.6% yield. So if you bought the stock today, Apple currently pays 92 cents per share for its dividend on today's stock price of roughly $166 per share. However, the dividend I yield on Apple stock is much higher because I've owned it for much longer. So when I started Sidoxia Capital Management at the end of 2007, I purchased Apple shares for roughly $7 per share. So all the way kind of towards the middle of the chart. So I have made on those purchases more than a 20-fold return on my investment. Not bad, but it gets even better because when I bought Apple back then in 2007, it didn't even pay a dividend. But over the last decade, Apple has almost tripled its dividend from the 38 cents that it started to pay, I believe, in 2012 to the 92 cents it pays today. And I expect Apple to increase its dividend again in the not too distant future. So since I bought Apple in 2007, my yield on those shares are greater than 13%. So instead of dividing the 92 cents by the $166 per share, I take the 92 cents and divide it by the $7 that I paid, not the $166. But of course, if I were to buy more shares today, I would only be earning 0.6% on those new shares. Now, hopefully the Apple story isn't over. And of course, I'm hoping Apple will increase its share price by another 10-fold this next decade and triple the dividend again. But you know, not all elephants can dance. This is a large multi-trillion-dollar company, so I'm not holding my breath. But it's been a tremendous investment over, you know, the last decade. Okay, switching gears a little bit. This chart shows treasury yields versus dividend yields over the last 75 years and demonstrates how important interest rates and dividends are in stock valuations. So you can see the red line is the treasury bill yield, and the blue line is the S&P 500 dividend yield. We saw the importance of interest rates, especially over the last 1 to 2 years, when the Federal Reserve increased their interest rates at the fastest pace in over 40 years. And of course, anybody that's followed the stock market last year, this put tremendous pressure, not only on stocks, but on bonds as well. And for definition purposes, as you know, the dividend yield ratio is calculated by taking the dividend per share in the numerator and dividing it by the stock price per share in the denominator. So if you look at this blue line, you know, over the last 20 years, you can see that the dividend yield for the S&P 500 has hovered around 1 to 2%. The reason why the dividend yield hasn't gone up, I showed you the chart of rising dividends, 6 to 7% a year. The reason why the yield hasn't increased at that same rate is because stock prices have tripled over the last 20 years. So essentially, you have a rapidly rising numerator and a rapidly rising denominator, and that's what's kind of kept it flat. And the dividend yield over the previous 20 years, you know, we had rapidly declining disinflation and interest rates were coming down, and there are other factors that went into that. So anyway, this gives you a good perspective of how investors are constantly comparing what are the interest rates I can earn in the bond market and what are the interest rates on the dividends I can yield in the stock market. Okay, another definitional important definition of dividends is the dividend payout ratio. And this shows you what the dividend payout ratio has been over time. And currently we're roughly at 40%. And what that payout ratio definition is, it's the percentage of profits that are paid out as dividends. So for every dollar of profits that the average S&P 500 company earns, they're paying out about 40 cents on that dollar. So that gives companies a lot of flexibility to increase that ratio over time if they'd like. Of course, profits can be volatile, so they don't want to pay out 100% or too high of a percentage. And then ideally, we want those profits to be growing over time, which allows the companies to increase their dividend as well. There are a lot of choices that companies have for their profits. And I'll talk a little bit more about that in a following chart, which say dividends only tell part of the story. So as I indicated, there are a lot of choices for profits. Profits can be used for share buybacks, debt pay down. Profits can be used for acquisitions. Or companies can simply allow the cash and profits to accumulate on their balance sheet. So what this chart shows you, so I showed you a different chart of dividends rising. That's the green part of the chart. This is over the last roughly 25 years. And you can see they're constantly rising. And that's about 500 billion with the B dollars per year that companies pay out in dividends. The share buybacks are more discretionary, and you can see that they're a little more volatile, but they too have been increasing over time to roughly $1 trillion with a T. So combined, this is S&P 500 companies are returning about $1.5 trillion to shareholders through share buybacks and dividends. And yeah, that's just a summary of what I talked about earlier. Okay, so in finishing up, I want to finish with some of what are called the dividend aristocrats. And these are generally defined as companies increasing dividends for at least 25 years. So, you know, when you invest in a bond, the company doesn't call you up and say, hey, Mr. Jones, this has been such a great bond holder. We're going to increase your coupon payment. As we discussed, those bond payments are fixed. But these listed companies just every year decide to pay you more. And it's a powerful trend to participate in. So you have companies like Procter & Gamble. They've increased their dividend for 67 consecutive years. 3M, Coca-Cola, 61 years, Colgate-Palmolive. This happens to be one of our investments. Nordson Corp, they're an industrial packaging, adhesives, and coating company. They've increased their dividend for 60 years. Target, PepsiCo, and Walmart for over 50 years. You know, we have some other investments. You know, an example is a lithium producer for electric vehicles. They've been increasing their dividend for more than 25 years. So, like I said before, when we looked at some of that, the power of compounding, if you can identify specific companies, it's a powerful trend that will help your investments increase over time. So with that, I think we'll finish up for now. I'm going to turn it over to Kevin Weaver and Marche for any questions and answers, and I'll be happy to take those questions.
All right, great. Thanks, Wade, for that dividend overview. So we've got our first question here. I'll take a look. Wade, what goes into a company actually deciding to pay out dividends? Mutual funds and ETFs, I mean, do those have dividends too? What would you say, why would you choose a stock that the company may or may not choose to pay out a dividend?
Yeah, so the logistics around paying a dividend happen at the board level. So every publicly traded company, they have a board of directors, and they periodically meet. Typically, it's once a year, a decision is made about capital allocation. And I described some of the things that companies do with their capital. They can pay a dividend, they can buy back stock, they can do mergers and acquisitions, or they can do a combination of all the options. And so, like I said, most companies do not pay a dividend. There are literally thousands and thousands of companies now. The S&P 500, as I showed, the vast majority do, but these are the largest blue chip companies in the world. And so they have a lot of financial resources to pay a dividend, and investors like receiving, that quarterly check. Now, deciding between an individual stock that pays dividends versus a mutual fund, yes, you can choose either one. There are diversification benefits for owning a fund, but there is no specific decision. In a fund, it's just a basket of different stocks. So you might own a growth fund or a value fund or a banking stock fund. Each of those funds will own a basket of different companies, and a various percentage of those companies will be paying a dividend. So there's no decision process being made at the fund level.
All right, yeah, no, thank you for that. And thank you for the question. Wade, you were talking about the dividend aristocrats, those kind of top 20, 25 names. Are there funds out there that will simply buy those long-term? Is there a dividend aristocrats ETF? And if there is or isn't, what's wrong with somebody just simply finding that list, adding those 20 stocks to their portfolio and let it sit? What are the pros and cons of doing it that way?
Sure. So the short answer is yes. There are various dividend or dividend aristocrat types of funds. And just like any investment, there are periods of times when people will pay higher price for receiving dividends or invest in those companies. And typically, those types of companies are going to do better when there's a lot of volatility or stress in the financial markets. Investors will be looking for stability and consistency, and people will migrate to those types of dividend aristocrats. Now, there are periods of time during stress and volatility where we'll look at it and say the price that investors are paying is too high. So it's like insurance. A lot of times you're willing to buy insurance, but if you're looking at home or fire insurance and the house next door is on fire, the price for you to buy that insurance may be too costly. Maybe cheaper just to build a new house. So some of these stable companies, we have to look at the price also. So and so there, the short answer is there are periods of time that these types of stocks will outperform and periods where they'll underperform. The argument I would make is that we want to include in our client portfolios companies like the dividend aristocrats that can grow their profits and grow their dividends over the long run, because we think that it'll outperform other investments. But we want to keep names out like Intel, which had increased their dividends for many years, and then all of a sudden have cut it. And so we want to stay away from those types of stocks.
Got it. Wait, circling back to your dying tree analogy, there are a couple questions on that. Could you just again rehash that, and how would you be able to identify a stock as a dying tree?
Sure. Yeah, we spend a lot of time at Sedoxia really scouring through financial statements and SEC disclosures, looking at balance sheets, income statements, cash flow statements. So we're really trying to take the financial pulse of each company that we look at. And, I could spend a whole nother webinar going over the types of details that we look at to analyze the health of a company. But generally speaking, for the dying tree type of companies, you're going to be seeing a deterioration in their fundamentals as measured by the trend in their sales, the trend in their profits. Things that we like to avoid are increasing debt levels. When we go into slowing economic times or potentially a recession, those companies that are paying a dividend are forced to cut their dividends. And typically when you see these dividend cut announcements, or people are reading through the tea leaves and reading the writing on the wall, the stocks go down in value quite a bit. So we spend a lot of time going through detailed financial analysis to identify those dying trees.
And this is kind of related directly to that fundamental analysis that we do. How would an individual, on their own try and screen and find these high quality stocks? Is that something? Are there tools out there that people can do that, or how would you recommend someone trying to figure this out on their own?
Yeah, there are publicly available tools. I would caution individual investors to not rely solely on the data. What you'll find out with a lot of these free services is that the data you get is not always accurate. So, kind of the garbage in, garbage out concept. But with that said, I think you could use things even like Yahoo Finance, Morningstar, Bloomberg. You could even just Google for dividend screeners, or high dividend paying stocks. And then I would encourage you to do research on those individual stocks yourself. I would maybe suggest that you go to the SEC. We use a resource called BAM SEC. That's Boy, Apple, Mary, BAMSEC.com. And you can get access to every publicly traded company, and you can read through the annual report. And some of the language is really dry and legalese, but a lot of the annual report is written in easy to read language, and you can learn about the company, what they do, how they make profits, what are the growth opportunities, what are the risks. That's what I spend a lot of my time looking at when we're analyzing companies.
Wade, when we're looking at screeners, you'll come across those outliers where you have a 50%, 70% dividend yield on certain names. How does that happen? And, what cautions would you put around, looking at names like that?
Yeah, typically in those situations, it's kind of what your grandmother told you. If it's too good to be true, it probably is. And so typically in those situations when the dividend yield is so high, the dividend is likely to be cut or go to zero. So, if you have a stock paying a 5% dividend and the stock goes down 50%, all of a sudden you're paying, a 10% dividend, and if it goes down 75%, it's paying a 15% dividend. But it's only temporary because there's a reason the stock price is going down so much. So it's that numerator denominator aspect to dividend yield. When the denominator is going down, that increases the dividend yield because the numerator is temporarily staying at that fixed rate. But what the analysts are telling you now, having said that, there are occasions where the price is disproportionately punished. And we can think of COVID, for example. So there were instances where a company may be paying a 4 or 5% dividend, and because of a temporary dislocation in the market, the price went down, the dividend yield went up to 7-8%, and we would opportunistically go in and buy that to try to lock in that 8% rate. And then again, if we're crossing our T's and dotting our I's correctly, that dividend will increase over time, and that 8% will only go higher. So that's essentially what we're trying to do. But just like anything, it's easier said than done, and it takes a lot of work to identify, and every situation is different.
Yeah, no, absolutely. Yeah, I think that's important that people, do their homework. If you're going to be selecting these stocks yourself, just the highest dividend doesn't necessarily mean the best risk reward. Wade, we had a question on asset allocation. So when we're building custom portfolios and asset allocations, we're creating diversified portfolios based on liquidity and timelines. Does somebody's age affect the amount of dividend stocks we would put in someone's portfolio?
Yeah, I mean, the short answer is yes, absolutely. You generally speaking, as you get closer to retirement or in retirement or deeper in retirement, you want to lower the risk profile of your overall portfolio. And one way of doing that is to increase the proportion to fixed income or bonds, where you're receiving a fixed coupon interest payments. The volatility of that portion of your portfolio essentially acts as shock absorbers to your portfolio. So when there's a lot of volatility in the stock market, the volatility in your bond or fixed income portion should be lower. 2022 was a different scenario, something I haven't seen in my 30-year career, and even longer than that. You can go back. So last year was kind of a anomaly, but in general, yes, you want a higher proportion towards dividend income related stocks, so you can use those resources to cover your expenses.
Got it. We just have a couple more questions here. One is, along the bonds you're talking about, and we've seen this too. Some people are just they're just not familiar with bonds. They're not as easy to buy an individual bond online. What are bonds, liquid? Can you cash out? For some people, they may seem a little scarier. So, would you say that, dividend stocks and bonds are equal in the scare factor? Just break that out on, why people shouldn't be afraid of investing in fixed income if, that's what their portfolio needs.
Yeah, well, that's a good question. It is definitely true that corporate bonds are more liquid, and you can run into some pitfalls if you don't properly purchase them. We use something that you may have heard of called limit prices to try to prevent dislocations in purchase prices. And as we work with institutional custodians, we have more sophisticated resources to purchase those liquid bonds. But there are ways through any brokerage account that you can do this. And you can go directly to Kevin, you can provide the name of the Treasury website you can go to.
Yeah, absolutely. Treasury Direct. If people want to get, those higher, take advantage of the current high interest rates, and how do you get a safe return, or, a government guaranteed return without having to go to the bank and have to pay the bank. You're going to lose maybe 1% or so. You can go to treasurydirect.gov and, buy yourself your own treasuries kind of directly using the U.S. Treasury Department as your bank, if you want to get maximize your risk-free.
Yeah. And I would just point out there are risks there too, as we found with Silicon Valley Bank, which basically had to close down because they purchased riskier long-term dated treasury bonds. So that is a caveat. So there are things that we as long-term investors can help decipher as far as interest rate risk and duration and things like that.
And kind of wrapping up, what's the rhyme or reason as to when dividend payments go out? Can people rely on this as a monthly income stream? Is it less common?
Right. Yeah, the typical stock or company that pays a dividend, they do it quarterly. And so those are pretty consistent. Now, every company has, not every company, but many companies have different fiscal year ends, which will affect the timing of those quarterly payments. So if you buy a fund that includes dividend paying stocks, those typically will pay a dividend on a monthly basis because just the logistical aspects of companies that pay their dividends. So there is no real rhyme or reason when you're talking about a basket or group of companies that pay a dividend, and that's why if you have a fund, you will get a dividend on an income on a monthly basis versus an individual stock that pays quarterly.
Great. Well, unless we have any last minute questions, we're welcome to take them. Otherwise, Wade, I really appreciate you breaking that down for everyone.
Yeah, thank you.
Absolutely.
Yeah, I'll turn it over to Marche.
Excellent. Well, folks, we want to thank you for being here, and we want to thank our speakers. Wade, if you can just go ahead and put it to the next slide. I'm not going to take over your screen here. And we don't want to thank the folks at Sedoxia for being here, and also for the organizations that have made this webinar possible today. To our people who have attended, look for an email with a link to a replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, folks, thank you so much for coming, and we're glad to help answer any more questions if you need to contact us. And you have a wonderful day. See you at another webinar soon. Goodbye, everyone.